Most people want to skip saving because they just want to be invested and, don't make any money on savings accounts and blah, blah, blah. I don't care.
So teach me to fish. What are these big dogs doing?
So they look at, so it's two ways to look at it. So they're doing the complete opposite. So while they're teaching you to buy and hold, they're creating velocity. So when you look at investing, and I think investing is, so people say, I want to learn to invest. No, I don't give investment advice. I help people play defense. Okay. And so one of the things they do is, let me give you the principles that we've boiled down from studying Kiyosaki and other stuff. And it's kind of from my mentor, Kyle Christensen, has a great book called Principles-Based Planning. And that's kind of what I'm a proponent of. So the principles, what do? I teach principles to help our clients become and remain financially free. Okay. Passive income greater than expenses. So if that's what you want, that's what we're talking about. So what do you have to do? Save. Okay. See, most people want to skip saving because they just want to be invested and, don't make any money on savings accounts and blah, blah, blah. I don't care. Okay. It's the habit of saving. Save what? 15 to 20% of your gross income. All right. And we'll get into it later. I'll show you a little easy, simple thing to kind of, automate that. Okay. The second principle, and if you look at them, all good investors, if you check out Kiyosaki's book, Who Took My Money, and what's the other one? Rich Dad's Guide to Investing. They all invest with insurance. So you have to play defense. You have to have what I call a fortress balance sheet, which is where you're looking at your liability coverages. Do you have umbrella coverages? Do you have adequate life insurance? Do you have a state trust and all that stuff set up? So that's a whole process that we teach called maximum protection. What is the maximum you can get, not the minimum? You want to, they set up legacy. They want to make sure they leave a legacy of wealth and wisdom, which is our third principle of personal finance. The fourth principle is liquidity. See, we're taught to invest, which is send money away from us. I teach people to capitalize, like accumulate financial value. So, and then we teach them to put it somewhere that allows them to leverage it or collateralize it so they can use it to buy other assets so they don't have to liquidate the account. So most people put money in and take it back out. They put money in, take it back out. And see, one of the things they don't teach you in personal finance is the concept of opportunity cost, because you finance everything you buy, right? So you either pay to use somebody else's money, or when you use your money, you're giving up interest you could be earning. And a lot of people don't calculate that. But that's a real cost. And the last one is, which is what your listeners and what we're talking about, is velocity of money, which is just an economic principle of, can you, like Mr. Wonderful, if you watch Shark Tank, he'll go, hey, I'm going to put this $1 million in your business. What does he want to know? How soon am I getting my money back? Right. With friends. And then what is he doing with that? Is he puts it into another deal. Then he gets it back. He puts it into another deal. Now those deals are still, he's in them and they're throwing off cash, but he's got his capital out. So he has no risk. He's got his money back. And that's velocity. Okay. And on the real estate, that would be the Burr method. In business, it's how many times can you turn over the product. So money is made by the movement of money in motion. And then then they want cash flow. Then they want it leverage. And then they want, they protect it, or they store their cash in like insurance-based products. And so that's the fifth principle. So that's what they do. Okay. And but guess what? All of those strategies, they work in personal finance. So we just kind of boiled it down into a process. And but principle 5 is you. Like, that's you figuring out, okay, here are the 4 asset classes: business, real estate, paper assets, and commodities. What do you like? What do you understand? What do you want to become an expert at? Because that's your job, to make yourself rich. There's nobody outside of you that can make you rich. You can get mentors and you can learn stuff, but you've got to do it. And if you don't want to do the work, I always tell people, don't call me, okay? Because I can't help you. You need to call your cousin at Primerica or Dave Ramsey coach or whatever, because it's designed, all right, look, just give your money to us. Let's just max out your 401k and get out of debt and keep it moving. All right, for some people, that's great advice. But for people that want to be rich, you can't do that stuff.
Yeah, absolutely.